Well, good morning. It is Thursday. It's October 2nd, 8:30 a.m. Eastern. Welcome to FX Street. Great to see everyone here. I love to see my regulars. Thank you very much for joining us. Welcome back, one and all. It's 8:30 a.m. As we speak, Jean-Claude Trichet, President of the European Central Bank, is holding a press conference regarding the ECB's decision to leave interest rates unchanged at 4.25%. We're looking at a euro-dollar daily chart, and it's been quite a rocky couple of days, that's for sure, and it's not even close to being over. We have a look back at the third quarter. This is what we're looking at today. We're going to look at the chart developments. We're going to try to make an educated guess what the rest of the year may look like moving forward. Now, of course, if there's any specific charts that you'd like to see, any specific currency pairs, I'll be more than happy to plot them. I do not have the ZAR. I don't believe so. But I do have all the majors. The euro, the pound, the Swiss, the Aussie, Kiwi, CAD, the dollar, and the yen. So any combination of those, I'll be more than happy to plug in. We're looking at the euro-dollar daily chart now. We've had really quite a dramatic turn of events. I want to take a look back at the past few months or so and try to really capture what has happened so far and what we can expect moving forward. And I think one of the easiest and most logical ways to start with technical analysis is to use horizontal lines, horizontal price levels. This is a trick that a trader taught me a long time ago. I think it applies better to the foreign exchange market because, well, the price of the euro and the price of the dollar affects each and every one of us, I think, on a more personal basis than the price of Apple stock or former Wachovia stock or whatever it may be. But we can see here, the euro-dollar daily chart, we had that dramatic double top, all-time contract highs, just a hair above the 160 figure. Large round figures are important, 160, 159, etc. Then we established this triple bottom, arguably right above the 153 figure. Actual lows are 152.83 on May 8th of this year, so we'll call it 153. Okay, these are two horizontal price levels so far. Obviously, the market has broken down dramatically. More recently, again, we're going to see hitting lows. And if you can't see the chart, please let me know. I'll be more than happy to refresh. Hitting lows on September 11th of all dates, hitting lows of 138.79. 138.79 was lows on September 11th of this year. We rallied back up, and we've hit a little bit of lower lows, 138.74 currently, hitting lows of 138.53. Now, the former top that we hit before turning back to the downside, how did we know? Well, we didn't know, but how did we have a good idea that the market was going to stop there? Well, our friend Mr. Fibonacci certainly helped answer that question. Drawing the Fibonacci lines from the all-time contract highs of 160.37 on my charts down to what we know were the lows, we see the market made a turn just right around the 38.2% Fibonacci level, actually a little bit above that, but not too far either. And drawing more horizontal lines, we can see there was a former triple top around 149. That was exactly the 50% Fibonacci level. And there was also an inclining triple bottom, which we'd have to use an uptrending trend line to plot. And that landed right around 149.50. So the 50% Fibonacci level was really the logical turning point. U.S. unemployment claims 497,000. Thank you very much, by the way, John. So the 50% Fibonacci level, if you had asked me this was the important level, it was around 149.5. We did not get up there. We came up to highs around 148.65. So we came with about 90 pips or so of that high. Not too bad either, though. Let's zoom in now, by the way, on the euro-dollar chart, see what we have here. Intuitively, a lot of traders may guess, hey, is this a double bottom pattern? Can the euro-dollar reverse back up? Well, I'll give you my own 2 cents. Number one, I think the answer is no. Not that I don't think the euro-dollar can bounce back up. Sure, it can. But, as they say, the trend is your friend, and the trend in the euro-dollar is clearly to the downside. European Central Bank leaves rates unchanged, yet the euro-dollar continues to go lower. Let's look at a 5-minute chart, and we can see, just for a moment, the 5-minute chart shows us the euro-dollar dramatically now selling off to the downside. Going back to a daily chart, by the way, you might ask, you might wonder, when was the last time the euro-dollar was this low? We have not seen the euro-dollar this low since September September 17th, 2007. So including today's move, which turned out to be a pretty dramatic move after a very quiet morning. We had, CPI 5 a.m. Eastern in the Eurozone, very little market reaction. But now the market's starting to accelerate to the downside. We have not seen these lows since September of last year. This has erased all of the euro-dollar gains in the past 12 months. Unbelievable. And now that the market is hitting this magic 1 year low, 1 year high type of phenomenon does occur, where we can imagine every single trade that is long the euro-dollar and still open, well, not only is it eating away a little bit of carry trade, but also, well, you're gaining on the carry trade, shorting the euro-dollar would lose on the carry trade, but you're losing on the capital. And now that every single long trade over the past year is losing money, well, that gives us more reason to get out of our position, to get stopped out, margin call, etc. So with that said, every single short trade is now making money over the past year. Can I analyze a weekly chart of the euro-dollar, see what's next level for the euro? Absolutely. I kind of read my mind. I'm glad you did, though. I'll show you why. Take a weekly chart going back to the lows of February 2002, 6 years ago. Draw an uptrending support line and connect that line to the lows going to December 2005. Ideally, to the lows there. That's a little bit better. And we can see, I think you read my mind. We can see here that the euro-dollar is basically flirting right now with a very, very significant uptrending support line that was initiated, again, February 2002. Connect those February 2002 lows up to lows of December 2005. Zooming in now, this is the weekly chart, and we can see we're basically right here. If we close negative for the day, if we break to new lows and close at new lows, we've already broken to new lows. If we break to new lows and close at new lows, and we break below this trend line, I think the euro-dollar could have a much further move to the downside. Where could it go? Well, you might notice the Fibonacci line's below us. I'll zoom in one more time, and it's a very, very, oops, I can't do that. It's a very, very fun technique to use. Most of us probably know how to use Fibonacci in the regular or the normal application, where you draw the Fibonacci lines from the top to the bottom in a downtrending market, of course, from the bottom to the top in an uptrending market. In this case, since the market's going down, we start at the top, we go to the bottom, and we see the market retrace back almost to the 50% Fibonacci level. Kind of looks like a head and shoulders now that we look at it too, right? Well, at any rate, we see that the market found a lower resistance level at a Fibonacci line. Or in other words, the Fibonacci lines helped us to anticipate where a lower resistance may emerge. Well, now, where can we find a price target if we're shorts? If we're lucky enough to be short the euro-dollar, where could we possibly find a price target? Well, I would say take the Fibonacci lines, and instead of retracing the percentages back up, take the same percentages and subtract them from the bottom. What that does is gives us a possible price target. Just to give you an idea where the euro-dollar may find its next logical support level, 133.74 or 133.83 actually, 23.6% Fibonacci projection level. That's 23.6% of a former trend subtracted from what we knew were the bottoms. 38.2% Fibonacci projection at 130.60. The 50% at 128. The 61.8% is at 125.60. The 78.6% of this former trend subtracted from the bottom puts us all the way down, euro-dollar, if you can believe it or not, at 122. We don't know which Fibonacci projection level it's going to land on and find the next support, but I would say conservatively at least 23.6. That's our first level. That's at 133.80. So for short, I'd like to hold on to a piece of the trade because I think we could definitely see lower lows in our future. The question is, if we're shorting euro-dollar, where would be the stop loss order for both daily and weekly charts? It's an excellent question. Well, for daily and weekly charts, start with the weekly chart since we're at it. Sounds like a long-term trader. A trader of my own heart, so to speak. I'm a long-term trader. It's a great question. Now, if we had initially taken the short trade, my gut level feeling on a weekly chart is to place the protective stops above the highs of the previous week. Unfortunately, those highs are all the way up 1,000. 1,000 pips higher than here at 148.65. Are we willing to give back 1,000 pips? That's tough. I love it, Boyke. It's really tough to give back 1,000 pips. On the daily chart, where do we place our stops? Well, again, 148.65 represents this big swing turn. Now, if the euro dollar continues lower, what we can do is we can now say, hey, let's see if this former support, 138.79, former low of September 11th, becomes our new resistance. It's too early to know that yet, but what we want to do is wait for the market to sell off some more, rally back up, test and fail to break back above 139. 139 is maybe a level that we could adjust our protective stops to be below or to be above as long as the market stays below. Now, it's a really, really good question, and it's tough. I hate to say give yourself 1,000 pip stop. Who wants to give back 1,000 pips? Another trader may say, hey, let me hedge on the way down. Let me buy a little bit of euro dollars in another account, or maybe buy euro yen to hedge my euro shorts. Those are all possibilities, although not perfect. In trading, I think sometimes the best solution is compromise. We don't want to hold this and give back 1,000 pips. And on the other hand, we don't want to cover the trade now, close our position 138, only to watch the euro dollar go to 122. And we said, hey, we made 50 pips. We could have made 1,600. So I suppose a compromise, if we have the luxury, is to take profits in pieces. As the euro dollar starts clicking to new lows and it finds its short-term support levels, take a little bit of profit. One tool that I really like is the Bollinger Bands. If I can find a way to plot them. Oh, it doesn't let me maybe on a 4-hour, on a daily chart. Well, at any rate, the Bollinger Bands are one tool that we can use to really know where to take profits. There we go. Insert indicators. Beautiful. I knew we could do it. Okay. So on a daily chart, we can see, hey, we're below the lower, we're just at the lower Bollinger Band right now. But if we do find some sort of support lower on, maybe in the 4-hour chart, we'll see the market find a pattern, take some profits maybe along the way. Always holding on to a piece of the trade. Now, the good news is if the market rallies back up, we can add to our short trade at a better price, obviously booking in profits along the way. And if the market continues lower, well, that piece of our trade that remains open continues to make money, which is always good. So going back to a daily chart, and I think probably that's the best way, although probably not very conclusive, to answer your question, is to say that, initially based on a weekly chart, even a daily chart at this point, place your stops above that swing high. Unfortunately, that swing high is much, much higher than here, by 1,000 pips higher. Would I place a stop? Some traders may say, well, I could place stops above today's daily candlestick high, above the 3-day high, which really doesn't help us that much either. That's tough. That's tough because the market, I could very well see the market bouncing back up to the center of our range, stopping us out at a little bit of a loss, a little bit of a gain, but that doesn't serve our purposes. We want to either take, a small loss or a very, very nice gain, especially for long-term trading. If we're going to risk 100 or 200 pips on a long-term trade, we want to have the potential to make at least 3 times that amount, and hopefully more than that. I hope that answers your question. Roundabout way, I suppose. But keep them coming. By the way, if there's any other charts specifically you'd like to see, please do let me know. But currently, based on the market reaction from the European Central Bank meeting, leaving rates unchanged, the euro dollar is clicking to new lows we have not seen in about a year now. As they say, the trend is your friend. I want to look to sell shorts. At this point, I would not want to sell short here based on anything a long-term trade. But what I would want to do is see, hey, if we very much break below 138, maybe go to 137, 136, then we rally back up. Will 139 be our new resistance? It was our former support. Euro dollar daily average range, ATR is around 300 pips. Shouldn't be the stop loss, around 3 times ATR. Rame, it's a great point. Yes, maybe. Some traders do use the ATR. ATR does stand for average true range, and it very simply calculates exactly what it is. The average range. It's a little bit more complicated with calculation than that, but it essentially calculates the average range every candlestick. meaning on a daily candlestick, 300 pips may be the average range from low to high. On a 4-hour candlestick, obviously going to be a little bit less. Some traders will say, I will like to use 3 times the ATR, meaning I want to bet that the market will not go 3 times more than the average range. 3 times 300, by the way, puts us about 900 pips higher, and that does make sense. 900 pips higher puts us right around the swing highs that we spoke about. So it does sound right. I don't typically like to use the ATR because it sort of ignores, I think, a very important facet of the technical analysis, especially foreign exchange technical analysis, which are support and resistance levels, Fibonacci. If ATR agrees with it, in this case it does, yeah, absolutely. Why is the Kiwi yen down so much of last week, and what are my predictions? Great question. Let's go to a chart. Kiwi yen, Kiwi yen, Kiwi yen. All right. Now, I do have to apologize ahead of time. The Kiwi yen on my chart has a false tick. I'll show you what I mean. And I'll refresh the charts here for you folks as well. There we go. Please let me know if you cannot see it. Now, this long candlestick wick at the bottom is a false tick. It was a bad piece of data. So the market did not go down 2,000 pips in one day and then back up. Just a piece of false data. So it does skew our charts a little bit. Why is the Kiwi yen going down over the past week? Well, it's a great question. I would say the number one reason is a very, very, and I cannot use very strong enough, a very strong Japanese yen. Japanese yen at 0.5% interest rates tends to benefit when other nations are in some sort of equity. I think we certainly can qualify for that this week. Watching the Dow, and not really happily, but seeing the Dow go down, I experienced the largest one-day point drop ever in the stock market history. Not percentage-wise, thank goodness, but still very dramatic all the same. With that said, the yen tends to benefit from that. Capital tends to move into the currencies with lower interest rates because it's perceived that they're more of a safe vehicle. Moving out of those currencies with higher interest rates. Well, the highest yielding currency in our majors, the 8 majors, the Aussie, the Kiwi, the CAD, the dollar, the yen, the euro, the pound, the Swissy, is the Kiwi, the New Zealand dollar. That's at 7.5% interest rates. The Kiwi's at 0.5%, the yen's at 0.5% interest rates. That leaves a 7% differential. That means if we were to buy New Zealand dollars and sell short yen, we would make annualized 7%. Obviously, every day we make 7% divided by 360 trading days. But when things look scary, capital comes out of high yield and moves into low yield, and there's not a better example of that than the Kiwi yen. So the delay, just have to sort out some technical issues on our end. Please let me know if the sound and video are coming through okay. I'll be more than happy to proceed. Moving the mouse around as we speak and testing the audio. Testing audio 1, 2, 3, 4. Okay, excellent. Alrighty. Well, again, we apologize for the interruption, and we're back. Okay. Getting back to the Kiwi yen. Kiwi yen daily chart. Why is the Kiwi yen going down, down, down? I think more than anything, it's an issue of capital moving out of a very high-yielding currency like the Kiwi, which is our highest, and into the very low-yielding, lowest currency, the yen. Moreover than that, the Reserve Bank of New Zealand has already cut rates once. It's anticipated they will continue. The slowdown in the commodity market certainly doesn't help either. We've seen gold down a lot today. I think it was down $17 at one point. Oil has been down a lot as well. As commodities pull back, so does Aussie and Kiwi currencies. They tend to benefit from high commodity prices. So I think you see a little bit of the opposite of what we saw over the past few years. Capital is moving. It's an anti-carry trade sort of trend. Capital is moving out of the high yield into the low yield. Capital is moving out of the commodity markets back into the dollar and back into low-yielding currencies like the yen as well. I think that is my best guess why the Kiwi yen has been going down. Other than that, I don't know any specific issues. I know the tanking report obviously weighs very, very heavily. I don't think it's that. I think it's more of a matter of really just this, that's the basic mechanism of the foreign exchange market, moving in and out of high and low yielding currencies. Now, taking a look at the charts, which is a little bit more of a logical way to go about it, we can see a downtrending channel the QEN did establish. I love when these trends are parallel, by the way. If you can find parallel trends, it becomes very, very helpful. Now, we eventually, I'll zoom in, daily chart, we eventually broke down below our downtrending channel. Drawing our Fibonacci levels as well. Take the most recent swing high. Well, I think most would argue before the market really decided to go down a lot at once. Take the highs going back from July of this year, the highs of July, on July 20th, down to what we knew were our lows, and we can see after the market initially broke down, we rallied back to the upside and hit the 50% Fibonacci level. That was roughly, to give you a price level, right around 7,400, 7,430 actually. By the way, notice the lows over here. This low, daily chart, August 13th, lows at 73.94 became our new resistance. Also a nice double top over here. Former support, new resistance, 50% Fibonacci level, beautiful. Kiwi dollar, Kiwi yen I should say, clearly the trend is to the downside. I only want to look for areas that sell short Kiwi yen. We're at 69.97 right now. The most recent swing highs, we can look for an area to sell short. 73.40, even better, former double top, right around 7,400. And you want to place your stops obviously above the swing highs, somewhere above the 7,400 level. Near-term target could be our most recent swing low, 67.19 on September 16th. And then maybe hold on a piece of the trade. We could see much, much lower lows in our future. I did see, we had to refresh. So I'm trying to find which currency pair it was. Someone mentioned after the Kiwi yen, was it the euro pound? Oh, the pound dollar, then the euro pound. Let's get to the pound dollar and then the euro pound, I promise. Okay, refreshing the charts. Pound dollar. Okay, cable dollar 175.80, just like the euro. Andrew, my pleasure, of course. Just like the euro dollar has come down a lot. We have really come off of highs, very significant highs. 201.55, just above double parity. That was July 15th of this year. Can you believe how much has changed since July? Well, draw the Fibonacci lines from the highest highs, again around 201.55, draw them down to our most significant lows. And the lows stand around 174.43. Now, unlike the euro dollar, the pound dollar has not yet broken to fresh one-year lows. If and when we do break these new lows, they will be lows we have not seen. I have to go to a weekly chart. That's how significant they are. A weekly chart shows us a lower low from 174.43 is going to take us back to 2006, April 2006, about 2-year lows if we get lower. The trend is clearly to the downside. Notice the nice turn we made, by the way, just above the 38.2% Fibonacci level. It also represents its former cluster. Notice when the market goes up very quickly or down very quickly, it can reverse course. But when the market starts to consolidate and go sideways, 1, 2, 3, 4, 5, 6, 7, 8, about 10 candlesticks moving sideways, this is what we call a little consolidation pattern. This consolidation pattern may be not very noticeable, but was very important because it represented our consolidation pattern as the market reversed back to the downside. Now, the question of the day, the $5,000 question, or I'd say the 5,000 pound question, is should we look for a double bottom pattern at 174.43 lows September 11th? I would say no. There could be a double bottom pattern. The pound dollar may bounce back up 10 pips. It may move back up 500. We don't know this. I like to place our trades with what we do know. What we do know is that the trend, first of all, is to the downside. We know that the Bank of England is much more likely to cut rates, I think, in the near-term future than the European Central Bank. And I think they're more likely to cut rates as one day, maybe, we'll see rate hikes in the U.S. I don't think in the next couple of days, but I think after elections coming to a new year, if and when the economy turns, I think rate hikes in the U.S. are likely. So fundamentally and technically, I don't want to look to buy the pound dollar. I think it's, as they say, trying to pick up dimes in traffic, so to speak. Great question. Why is the U.S. dollar going up while the Fed and Treasury are both flooding the market with the U.S. dollars, creating an imbalance in supply and demand? It's an excellent question. It took me wish that I continued to get a PhD in macroeconomics. My general opinion is this. I think the credit crisis has a lot of effect to this. It's making lending standards higher. It's making capital less available. It's making it more difficult to take a loan. This is driving interest rates up. Okay? And I think the anticipation of higher rates is helping the dollar move higher. The market also has a funny way. Remember, the market is a forward-looking mechanism. And the market is also trying to anticipate the next move. And I think what's happening now is because everyone in the States, and I think pretty much around the planet, I think everyone is now aware of the economic turmoil in the States, and because they're aware of this, including obviously the Senate and Congress and the President, etc., that there's a real possibility of a dramatic solution soon. And that anticipation of a solution is making the dollar go up. Say, okay, things are very bad right now. We know this, but everyone knows this. And I think now that, if everyone in the room sells dollars, what do we have left? A room full of traders that are potentially future buyers. So I think that the market's a forward-looking mechanism, and it's jumping forward a few months, a few quarters maybe, trying to anticipate, what will the economy look like after the Fed pumps in money, after a possible bailout package, and also maybe a possible interest rate cut or any other band-aid that they want to put on the problem. I think that's helping. I think it's helping the dollar a lot. Also, it does not hurt that the euro and the pound and the Aussie and the Kiwi all cannot do anything except go down these days. The euros are going down. European economy is even more of a basket case in the U.S. Andrew, yeah, you're right. I tend to agree with you. Germany already, I believe, analysts said officially is in some stages of recession, with other, at least Western European nations, anticipated soon to follow. Because, and we've been saying this for a while, that the U.S., because they're so far, some would say, ahead of the curve in cutting rates, they cut rates down at 2%, European rates still at 4.25%, UK rates still at 5%. If you believe that cutting rates was a solution, or at least helps, then obviously I think we're going to see the worst emerge and then the better occur sooner in the U.S. than in the other European nations. Philip says, I guess because nobody wants other currency than the U.S. dollar. At the same time as U.S. safe currency is treasuries. So if you want U.S. treasuries, you also need to buy U.S. dollars. It's a very good point. U.S. treasuries also represent a very nice hedge against a falling U.S. equity market. And the treasury market, if I'm not mistaken, is a much more significant market. Dollar also goes higher. It's a great point, Rama. Do you expect oil price to go down? Any chart pattern indication for price? We do have oil. I promised euro pound, but I will get to oil as well. Oil has been moving in the opposite direction of the dollar. It moved up when the dollar went down, and now that the dollar is going up, oil is moving down. It's really a great question. It's a very, very important point because there's a strong correlation. Let me get to euro pound because that really helps tie together the pound dollar and euro dollar pairs. Let's say we want to buy dollars and we want to sell a short, euro dollar or pound dollar. What is the better of the two? There we go, euro pound. And refresh. Okay. Daily chart, please let me know if you cannot see this, by the way. This is a long-term daily chart, euro pound. Clearly, to the upside, trend is your friend and the trend is going up. Now, what is discouraging about this trend is it appears that we have broken out of a long-term trend to the upside. This is going back to about June of this year, June 1st. But I would say that I do not believe that necessarily this is a huge reversal. Why? Because the euro pound, like the euro Swissy, like the pound Swissy, and like the Aussie Kiwi and the Aussie CAD, are considered more range-bound currency pairs. A range-bound currency pair is a currency pair when both currencies in the pair are derived from the same geopolitical, macroeconomic type of environment. The euro and the pound, the Aussie and the Kiwi are great examples. Now, the euro against the dollar or the dollar against the yen, when one currency goes up, another one tends to go down. So those are considered more trending currency pairs. So my point being is that because the euro pound is probably notoriously the most range-bound currency pair in our universe, expect trading ranges. This is a pretty natural occurrence, what has happened. Let's zoom in on the daily chart. Buy South African rands 11%, receive 8 for each US dollar. Wow. A range-bound market did exist. Nice triangle consolidation pattern. Triangle consolidation that we eventually broke to the upside. Now, if we were to read a Technical Analysis 101 book, specifically on triangles, and I'll zoom in on this triangle, what it would probably say, what I remember reading long time ago, was that technically speaking, if the market breaks out this triangle, we should not fall back below the center of this triangle, and definitely not below the support. The support's around 178. The resistance is around 180, actually 179 now, but we'll say 180. So 178 to 180, that's 200 pips. Half of that is 100. That puts us 179. Actually, if you do the math, around 178.75. I remember doing the calculation earlier. It's pretty much a midpoint. We're at 78.29 right now. It's euro pound daily chart. I didn't mean to say 178. I'm sorry. Let's zoom in. Do I have the right price on this? I have 78.30 euro pound. Yes, I'm sorry. You're right. I mean to say 78.29, not 178. I'm thinking the pound dollar. This is the euro pound chart, currently 78.30. Thought my charts are wrong for a second. Looking at the uptrending support line around 7,800, we definitely do not want to see. It's 1,000 pips. Almost made 1,000 pips in the trade, right? It's the easiest 1,000 pips we ever made. We definitely do not want to see the euro pound break below 7,800. Breaking below the lows of 77.93 would bring us out of this triangle and then give us a signal of a possible major reversal in the euro pound. I don't think it's likely, although, of course, the market always seems to surprise us at times, but it is possible that we find support around 7,800. And this shows us how much weaker, especially today, the euro is than the pound. I think long term, I think the opposite holds true. Until we break, if we break 7,800, my opinion changes. But as long as we stay above 7,800, I think the euro pound eventually resumes somewhat of an upward course, obviously to the upside. In the case of the bailout plan as approved tonight, would you expect a strong rebound in euro dollar later due to greater deficit in the U.S., more supply in the U.S.? Wow, what a great question. Well, we saw, I would say, we could attack this question from two different sides. We could say, well, let's try to rationalize this out. If the bailout plan is approved, it means more taxes will be raised, but then again, maybe stronger for the economy. That is an argument, I think both sides of the argument we can make very strong cases for. So I don't know if I could come to a conclusion. I'm sure that every one of you could make a strong case one way or the other. What I would say, though, is that notice how strong the U.S. dollar has been since we started talking about this bailout package. It seems that for some reason the dollar likes this bailout package idea. Whether it's approved or not approved, as we saw, the first one was not approved. The U.S. dollar has been strong. I don't think the U.S. dollar hinges around whether it is approved or not, but now that the government is taking very, very progressive steps to fix what is wrong with the U.S. economy, that greater level of responsibility, I should say, and I don't want to make any kind of political statement, but the greater amount of awareness of the financial situation, Secretary of Treasury Paulson, Ben Bernanke, the President, Congress, Senate, etc. Everyone who's important is watching and trying very, very difficult, including the presidential candidates as well, is trying very hard to fix the situation. And I think that effort benefits the U.S. dollar. And I think that's why, one of the reasons why the U.S. dollar seems to be working so well these days. And as they say, the trend is your friend. The dollar moved up a dramatic amount. July, August, about 1,800, 2,000 pips in the month of July and August in that area. Pulled back, but now is back to the upside. Long term, I think the U.S. dollar goes up. I was hoping for a little bit of a more dramatic pullback, though. But only time will tell. Suppose the money will go ahead again to Wall Street, so I guess the dollar will inject itself. Possibly. Possibly. It's a very, very good case. Both sides are a very, very good case of oil to argue. Speaking of oil, by the way, I'm thinking one step ahead of the game. All right, let me refresh. Daily chart oil. What a move we have had. Let's go to, you want to go to weekly chart? No, weekly chart's not good. Daily chart's better. Okay. Please let me know if you cannot see this, by the way. Draw our very, very simple uptrending support lines connecting lows of August last year up to our lows of January this year. And the market clearly broke that trend line. It's fun to draw them. Now, zooming in a little bit more, let's go to our daily chart, draw our Fibonacci levels from our all-time contract highs. 147.47 I see in my charts. That was July 11th. Wish I would have sold a barrel of crude oil back then. Well, the market came all the way down to very significant lows of 89.03, 88.88 actually, 88.88, wow. 88.88 on September 16th. Rallied back up to just above the 23.6% Fibonacci level. I expected the 38.2% to be a stronger resistance because it also represents the low of the former consolidation pattern going back to the second, third week in August. We did not quite get up there. But look at this, a little bit of a higher low. Now I would ask you, what chart does this look like? We came all the way back down, bounced back up, shallow bounce back up. We have not yet made lower lows or even similar lows, but we're definitely heading in that direction. If you were to say the pound dollar, I would say you are right. This is oil. This is the pound dollar. I'll refresh a chart for any reason if you folks cannot see. It's really fascinating, the correlation though. And I don't think this is very much a correlation between the pound as it is the US dollar. If we were to look at a dollar Swissy chart, you would see a very much an opposite correlation. In fact, look at the dollar Swissy chart. Ooh, dollar Swissy is very strong here. I'm going to go back to oil in just a moment. Here's a dollar Swissy chart. 113.87 charging higher. 114.05 were the highs today so far. We're just at almost the highs of 114.16 highs of September 11th. Again, the dollar made very significant highs September 11th, and it appears that the dollar is continuing to make higher highs all the while. We've hit higher highs against the euro. We have not yet hit higher highs against the Swissy, not yet against the pound, but arguably some of the other currency pairs we have. So which is the best pair to short? The question, going back to the euro pound chart, euro dollar or euro yen on a daily chart basis. We did not look at the euro yen. Let's go to the euro yen. I want to wrap up with the oil really quick though, just because I brought it up earlier. And then I promised the euro yen. Going back to oil, I would not want to be a buyer of oil, which I think is good news. I think it's a matter of time before we see a revisit of our 88 lows September 16th. And then when we break these lows, the trend is your friend. You got to break them sometime or another, I guess. We're going to go back to January 2008 highs, or lows, I should say, which I suppose is very, very good news for any one of us that drives a car or an SUV. Which is the best pair to short, euro dollar or euro yen? And notice, by the way, just one last thing on oil. The fact that it's going down, it's almost making the same chart patterns as our dollar on some of the dollar crosses. Specifically, the pound dollar looks very, very similar. And also the Kiwi dollar looks very similar to the oil charts. So there is a strong correlation between a strong dollar. And I think it's more than just simply that oil goes down and consumers say, hey, great, oil's down another dollar today. Let's buy something. Let's spend some money. Let's go into the U.S. economy. I think that oil, gold, other commodities act as a natural hedge towards a weak dollar. But now the dollar's strong, the capital says, hey, buying oil is not paying the bills anymore. Buying gold is not making us money the way it used to. Let's get back in the dollar. The dollar outperformed oil yesterday. the dollar outperformed oil last week. Let's get in some dollars. Let's get our oil. It's the better performing assets. So euro dollar or euro yen to the short side. Why is the dollar so strong? Well, in part we could say, and there's a lot of different reasons. In part we could say, well, it's capital moving out of these other currencies that are really starting to give back capital. Remember, at the end of the day, the number one reason why foreign exchange moves is the anticipation of higher or lower rates. I don't think the U.S. will raise rates anytime soon. Too many problems already. But it's speculated the European Central Bank will lower rates beginning of the year. Same with the Bank of England, possibly sooner. Reserve Bank of Australia, Reserve Bank of New Zealand have already begun to cut rates. Well, Japan can't really cut rates much more than they already have, 0.5% interest rates. Well, they haven't cut rates, but they can't go much lower. So I think it's the anticipation, number one, of lower rates in these other currencies. Capital is running out of euros and running out of pounds and Aussies and Kiwis and trying to find a safer home. In part, the yen, but 0.5% interest rate doesn't always pay the bills, no pun intended. So that's number one. Number two, commodities are coming down and are trying to find a better asset vehicle to make the money. And I think that is the dollar. And a lot of different reasons, and I think more than anything, it's just a natural market that anticipates the next move. So always trying to judge the next move. I think after we get through, well, we have 33 some odd days left to U.S. elections. So we have the holiday shopping season, and then we have another year, a January effect. All that tax money that survived this year is going to go back into the U.S. equity markets. I think January is going to be a strong month for us. Equity-wise, maybe for the dollar as well, maybe more than already. Taking a look at the euro-yen. So if we think the dollar goes up, do we want to short the euro-dollar? Yeah, but maybe the euro-yen is a better short. The euro-yen, it looks very, very similar, really. Taking a look at the euro-yen, drawing the Fibonacci levels from the July highs down to what we knew were the lows, we rallied back up to the 38.2% level, just a little bit above that. It's almost an equal battle at this point. I would say on a pound-for-pound basis, though, the yen is a little bit stronger than the dollar. But if you were to ask me which is a better short, euro-dollar, euro-yen, my opinion, I would say euro-dollar is a better short. Why? I think the dollar has a better chance to go up. They're starting to see some recent indications that showed a slowdown in Japan as well, for obvious reasons. A slowdown in the U.S., consumers can't buy as many Japanese goods, as well as Europe as well. That can trickle over to Japan. It's going to take some time for Japan to work itself out. But I think because I expect the dollar to go up higher than the Japanese yen, I expect things to be better in the U.S. I've become a very, very big bull on the U.S. dollar and a very big optimist. Obviously, things look very bad right now, but in the long-term future, I think things look great as far as buying a home in the U.S. or U.S. equity markets and or the dollar. Now, of course, you buy something today, there's still a chance that asset goes down, that asset vehicle goes down. So I don't think necessarily hit the bottom in all of our charts here, but things look good, I think, long-term. And that's why I like the euro-dollar to the short side more than the euro-yen. If one shorts oil futures and shorts pound-dollar currency pair, are they on the same side of the trade? The first thing, well, yes and no. Yes and no. It's more or less. We could say yes because both go down when the dollar goes up. But if the Bank of England cuts rates, the pound maybe goes down and oil does not. If oil goes down, if we have a hurricane, some sort of hurricane situation, and oil becomes very much a shortage, oil may rally and then the pound may go down, or the pound may not rally. So both pound dollar and oil tend to move down lately as dollars go up. But I think that's more of a case of, which came first, the chicken or the egg, meaning that I don't know necessarily that the pound dollar and oil have a correlation between each other. It's both oil goes down and the pound dollar goes down when the dollar goes up, for different reasons though. I am just about out of time. I do want to mention, by the way, if you folks have any questions, do not hesitate to contact me personally anytime at all, www.forexlounge.com. We host over almost 40 hours of live trading sessions per week, trade signals, intuitive charts, and much, much more. Contact me there. I want to thank you all very, very much for joining us. Thank you very much, FX Street, as well. Always a pleasure. And please see their calendar, because I'll be back on numerous times throughout the month of October. I thank you again very much for joining us. I wish you all a pleasant day. All profitable trades.